In the previous video, we learned how merchandising businesses record sales transactions and collect sales tax from customers. While businesses hope that every sale results in a satisfied customers, the reality is that not every transaction goes exactly as planned. Customers sometimes return merchandise because it is damaged, defective, the wrong size, or simply not what they expected. In other situations, the business may allow a customer to keep the merchandise while providing a partial refund or price reduction. Accountants refer to these transactions as sales returns and allowances. In this video, we'll learn how merchandising businesses account for sales returns and allowances and how these transactions affect revenue, inventory, and customer satisfaction. Understanding these transactions is important because returns and allowances reduce the amount of revenue a business ultimately earns from its sales activities. In a prior video, we looked at this listing of 5 accounts that are used to record merchandising sales transactions. One of these new accounts is for sales returns and allowances, a contra revenue account with a normal debit balance. Merchandise companies want to track how much merchandise is being returned by customers in a separate account. It is a problem area that companies need to address quickly if it is a material amount. Companies don't earn money by buying a product, shipping it to a customer, only to have to take the product back and return it to a supplier. Accountants closely monitor this account because a high amount in this account is a sign of ineffectiveness and inefficiency. The accountant would likely analyze the account and prepare a report that displays what products have the highest returns or what customer returns most of the products. Another possibility is that the sales team is sending too much product to customers, perhaps for purposes of increasing their commission, which is more of an internal problem that should also be addressed quickly. Another possibility is that the company just has too generous of a return policy and needs to understand the cost of that policy. Let's look at how we distinguish sales returns from sales allowances and how they are recorded. A sales return occurs when a customer sends a product back and requests a refund of the amount paid. Like many people, I order things online, and sometimes what arrives looks different than I expected, or is either too big or too small, it arrived too late, or just doesn't work. There are lots of reasons why a customer returns a product, and most retailers track their return reasons because those reasons are valuable information. When you want to return a product on the Amazon app or website, it asks you for the reason you're returning it. And once you return the product, you get your money back. The supplier may restock the item if there's nothing wrong with it, or repair it, or sell it as refurbished, or dispose of it. Sometimes it is impractical or even impossible to return the item. For instance, when it has already been consumed, or it's broken, and the seller still issues a full refund. Other times, the supplier issues a partial reduction in the price, a sales allowance, because there's some kind of problem with the product, but the buyer is still willing to keep it. So that's different, right? You want to keep the product or are willing to keep it, but think that the price should be lower because there is some kind of problem. Sometimes overseas companies also use allowances because the cost to ship the product back, especially if it's damaged and would just be thrown away anyways, is more than the product is worth. And the company just doesn't want to waste that money. Let's now look at a few examples to practice sales returns and allowances. Here's an example of a cash refund for a sales return. The company accepted a return and issues a cash refund for a return of $100 in merchandise sold for cash, plus sales tax of $8. Let's analyze this transaction by determining what accounts increased or decreased. This transaction, sales returns and allowances increased. Sales returns and allowances are a contra revenue account with a normal debit balance, and contra revenue accounts increase with debits. Sales tax decreased because the company refunded the sales tax previously paid by the customer. Sales tax is a liability, and liabilities decrease with debits. And cash decreased because the company gave money to the customer. Cash is an asset, and assets decrease with credits. So debit, sales returns and allowances, debit, sales tax payable, and credit, cash. We're now able to record this cash refund by writing the date into the date column, sales returns and allowances into the description column, and $100 into the debit column. We record the reduction in sales tax payable by writing sales tax payable in the description column and $8 into the debit column. On the next line, we slightly indent and write cash into the description column and $108 into the credit column. Let's look at how this transaction changes when the customer is a credit customer and hasn't yet paid for the original purchase. On January 20th, Anon returned a weight set that she previously purchased on credit. Max Out Sporting Goods issues a credit memo 101 for $216. So let's analyze this transaction by determining what accounts increased or decreased, the account type of these accounts, and then the debit and credit. In this transaction, accounts receivable decreased because the company issued a credit memo, but did not give money back to the customer, but instead reduced the amount Anon owes Max Out. Accounts receivable are assets, and assets decrease with credits. Sales tax decreased because the company refunded the sales tax previously paid to the customer. Sales tax is a liability, and liabilities decrease with debits. Sales returns increased. Sales returns are a contra revenue account with a nominal debit balance. Contra revenue accounts increase with debits. And we can now record the transaction in the general journal by writing the date into the date columns, sales returns and allowances into the description column, and $200 into the debit column. This sale also includes sales tax, and we need to debit sales tax payable because Max Out now owes less sales tax. We record the reduction in sales tax payable by writing sales tax payable into the description column and $16 into the debit column. On the next line, we slightly indent, write accounts receivable into the description column and $216 into the credit column. In this video, you learned how merchandising businesses account for sales returns and allowances. While businesses strive to provide quality products and excellent customer service, returns and allowances are a normal part of doing business and must be recorded accurately in the accounting records. You also learned that returns and allowances reduce a company's net sales revenue and therefore affect the profitability reported on the financial statements. Properly recording these transactions helps ensure that revenue is not overstated and that the financial statements provide a fair representation of the company's performance. From an accounting perspective, sales returns and allowances remind us that the sales process does not always end when merchandise leaves the store. Accountants must continue tracking transactions until the business and the customer have fully settled the transaction. In the next video, we'll explore two additional types of sales transactions commonly used by merchandising businesses: credit sales and credit card sales.